Have you ever stopped to wonder how we actually know what our governments are doing with our tax money? I mean, it's a massive multi-trillion-dollar question. Every single year, we hand over a chunk of our income, trusting that it's being used to fix our roads, fund our schools, and keep our communities running. But as we all know, blind trust isn't quite enough, right? We need verifiable transparency. And that's exactly what this explainer is all about. We're going to look deep inside the 2025 IPSAS Handbook, which is essentially the global blueprint for public sector transparency. It sets up the concepts and the rules that actually hold public institutions accountable.
Okay, let's dive into this. Here is our roadmap for today. First, we're going to look at the public finance rulemakers. Second, we'll explore why governments are so fundamentally different from private companies. Third, we're going to ask, who exactly needs all this data? Fourth, we'll break down the specific traits of good financial data. And finally, we'll explore the limits of information.
So, Section 1, the public finance rulemakers. Basically, who sets the global standards for public money?
Now, holding public institutions accountable isn't something that can just happen on a random, localized basis. It is a massive, complex, truly global problem, and it requires a highly structured, internationally recognized solution. Think about it. Without a standardized language of accounting, trying to compare one government's financial health to another's would literally be absolute chaos. So, who steps up to create that universal language? Enter IFAC, the International Federation of Accountants. Founded way back in 1977, they represent more than 3 million accountants across 135 countries. But their foundational mission isn't just about representing professionals, it's to serve the public interest. They do this by speaking out on major issues and supporting the development of high-quality international standards. Basically, they provide the structural support, the human resources, and the funding to make sure that global accounting acts as a robust public good.
And that brings us directly to the IPSAB, the International Public Sector Accounting Standards Board. While IFAC provides the support, the IPSAB is the independent body that actually writes the rules. They develop the International Public Sector Accounting Standards. Their entire goal is to make sure that financial reporting is consistent, high quality, and totally comparable across completely different jurisdictions all over the world. And they fiercely protect their independence through full transparency in giving the public access to all of their standard-setting processes.
Moving to Section 2, why governments are different. This is all about public service versus corporate profit.
Okay, so we've established who writes the rules. But what is the core challenge they're actually facing? Well, measuring a government's success is incredibly tricky because they simply don't operate like private businesses. Let me ask you this directly and take a second to really think about it. How is a government unlike a business? Think about the fundamental differences in purpose and operation between some massive international corporation and a nation, a state, or even just your local city council.
It really boils down to this divide. On one hand, businesses exist to make profits and generate a return on equity for their investors. They are judged almost entirely by their bottom line. But in stark contrast, governments exist to deliver services and redistribute wealth. They aren't trying to make a profit off of you. They are mandated to provide for the public, whether that's through national defense, public parks, or social welfare programs, and they often do this in a completely non-competitive environment.
To really grasp how this impacts the accounting side of things, we need to understand what the framework calls a non-exchange transaction. This happens when an entity receives value from another party without directly giving approximately equal value in exchange. Let's translate that heavy jargon into plain English, shall we? It's taxation. You pay your taxes, meaning you provide value, but you don't get a direct, perfectly equal product handed back to you right then and there. Instead, your money goes into a collective pool to fund necessary services for absolutely everyone.
So the crucial point is, governments don't exist to make profits. They exist to deliver services. This is a bold, anti-corporate contrast, and it sits at the very heart of public sector accounting. Because they aren't profit-driven, we can't just look at a simple profit and loss statement to see if a government is doing a good job. We need an entirely different framework to evaluate how efficiently and effectively they're actually using the public resources entrusted to them.
All right, Section 3, who needs this data? Let's talk about the audience for public accountability. We have these highly technical accounting frameworks being developed, but who is the actual audience here? Who is supposed to be reading and using these reports? Well, they're called General Purpose Financial Reports, or GPFRs, and the handbook specifies that these are intended to meet the information needs of users who are unable to require tailored reports. Now, what's really interesting about this is the distinction it makes. If you're a massive central bank or a huge regulatory body, you can demand an internal, fully customized audit.
But GPFRs, they are made specifically for the people who don't have the power to demand customized behind-the-scenes data.
And who exactly are those people? GPFRs are designed fundamentally for service recipients and resource providers. In the real world, that essentially means you. You are the resource provider when you pay your taxes, and you are the service recipient when you rely on public infrastructure. You, alongside your elected representatives, are the primary user of these reports. You rely on them to hold officials accountable and to make informed decisions at the ballot box.
Section 4. Traits of good financial data. What actually makes this data reliable?
The IPSAS conceptual framework doesn't just casually ask governments to publish data. It demands specific qualitative characteristics so that the information is actually useful to citizens like you and me. The framework outlines 6 mandatory traits. First up, relevance. The data must have predictive or confirmatory value. Then, faithful representation. Understandability means it needs to be written in plain language for a reasonable user. Timeliness means getting the data out before it loses its usefulness. Comparability allows us to spot trends over time or compare against other governments. And verifiability means independent observers could reach a general consensus that the data is accurate. Together, these 6 traits act as a rigorous, absolutely essential filter for transparency.
Let's zoom in on one of the most critical traits, faithful representation. To be useful in financial reporting, information must be a faithful representation of the economic and other phenomena that it purports to represent. Simply put, this means the data must be complete, neutral, and free from material error. It is definitely not enough for a government to just be legally compliant on some technicality. The true substance of what they are reporting has to genuinely reflect their actual financial reality. And to achieve that true neutrality, the framework notes that it is supported by the exercise of prudence. Prudence is such a fascinating concept here. It's basically an exercise in extreme caution under conditions of uncertainty. It means that governments absolutely shouldn't overstate their assets or revenues just to look richer than they are, nor should they understate or hide their liabilities and expenses to conceal their debt. It's all about playing it straight, avoiding bias, and being exceptionally cautious so the public gets the real, unvarnished story.
Finally, Section 5, the limits of information, looking beyond the balance sheet.
We've talked a lot about how to create great data, but let's see how this builds into a final major complication we need to address: the sheer longevity of public sector programs and nation-states themselves. A standard corporate-style balance sheet evaluates your current financial position, meaning assets, liabilities, and cash flows right now. But for governments, we have to look at long-term sustainability. Government decisions affect generations. If a city builds a massive new infrastructure project today, the financial consequences, the ongoing maintenance, the interest on the debt will fall squarely on future taxpayers decades from now. Because governments essentially exist in perpetuity, standard point-in-time accounting simply is not going to cut it.
Because of this incredible longevity, users of financial reports need prospective financial information to assess the future. Citizens need to know the government's capacity to actually fund future activities, what physical resources are currently available to maintain services, and the entity's ability to adapt to changing economic conditions or shifting demographics. We literally have to look well beyond the current balance sheet to truly understand if our government can survive and thrive over the long haul.
Which leaves us with one final, pretty provocative question to think about. Will your government have the resources to deliver services to the next generation? That is the ultimate test of public accountability, and it is exactly why these strict global accounting standards from the IPSAS are so vital. They give us the structured tools we need to effectively scrutinize our institutions. I really hope this explainer leaves you eager to look up your own local government's general-purpose financial reports, check their long-term sustainability, and see exactly how your resources are being managed for the future.